Okay, my name is Darren Joseph from TCJA Tax. We're a team that seeks to demystify the sometimes confusing world of cross-border taxation. And today we have the honor and the privilege of joining us, Edward Gordon. Edward, could you please introduce yourself?
Sure. I'm Edward Gordon. I own a company called Preservation Capital Partners. We've been doing tax structure work for over 30 years, both for U.S. domestic and for non-U.S. families and entrepreneurs. Some actors, some athletes, but not a whole lot. Mostly entrepreneurs and wealthy families.
Fantastic. And today we're going to talk about an often misunderstood concept called PPLIs. And something else popped into my head. I mean, that's the obvious stuff, but something else popped into my head. I'm going to run it past you. We know that I think by the end of 2025, all the benefits from President Trump's Tax Cut and Jobs Act, they would expire. And, you know, the lifetime exemption, which is, I don't know, somewhere between 12 and 13 million, would go down to, I don't know, maybe 5 million, but a lot less than that. Is this an opportunity? I mean, we don't know what's going to happen. Anything can happen, but let's assume it expires. Is this a strategic opportunity to transfer, to gift assets into the structure?
Absolutely.
Yeah.
Absolutely. We've had this several times in my 30 years where the threat of that exemption amount dropping. So we had lots of clients do things like, even temporarily, like lend money to the trust, and the day before, you know, if the exemption amount doesn't change, then they make, at that point, they forgive the loan, making a gift. And if it doesn't drop, then they make the gift. But either way, it gives them the flexibility of either pulling the money back or leaving it there. But I look at this product as just an insulating layer around the portfolio of assets to make taxation more efficiently. And for the vast majority of our clients, this is a pocket of money that's never going to be touched. So it really just becomes, at the end of the day, death benefit, which is paid tax-free, which can be used to pay estate taxes, all sorts of other things. It just makes things more efficient. And then I have other clients that utilize this just to, you know, I'll give you a prime example. Large family has great wealth. They have a significant amount of money sitting in a grantor trust. And grandpa's paying the taxes on all of this investment return that creates taxable noise. And that's a nice idea because grandpa paying the taxes on his grandchildren's trust is not a gift. But I would much rather see grandpa give all that money away, is paying taxes to charity, if he so desires to give it away, then give it to the government. So by going to the trustee and having the trustee acquire a private placement variable life policy, we put all those assets into the policy as a premium, and on an ongoing basis now, there's no taxation. But grandpa's not depleting his estate by the taxes being paid on the family trust. He could choose to keep the money, give it away, or live like a rock star. And then let's assume grandpa or grandma was the insured. When they pass, all of the assets of the trust get a step up in basis, quote unquote. It's death benefit under 101 of the code. There's no other place in the tax code where an asset held outside of a taxable estate, it's a reset in its basis, the way we could do this with life insurance. Now, that death benefit could be used as traditional death benefit to pay estate taxes. It could be done just to hold assets. There's a million different things, but you're creating a far greater efficient transaction by doing this.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.